the chat boxes and understand if people are putting in comments and asking questions as we go. So I do apologize if my eyes are not directly looking straight at you. Okay, so welcome to Money Matters. We are, where are we? October the 23rd, 2023. So yeah, the 23. And I sort of lost a couple of days there because I thought we were still on the 21st. So a quick apologies to my tenants who were expecting a pest visit today by the time I sent you the notice. The pest people were actually already on site doing the work. So I do apologize. I goofed up a little bit there on the a big time on the time there. Okay, so welcome to Money Matters. My name is Huong Liu. Hello. And I am from Cash Property Inc. That is the company that I run where we buy real estate. We help families become mortgage free. And so in the next 30 to 45 minutes, we're going to analyze a real estate deal, and then we're also going to answer some real estate questions that came through. So today we're going to analyze an opportunity in Winnipeg, Manitoba. So I'll give you a bit more details about that property. It's a single family, so it's not something that I'm actively looking at right now, but I want to bring it up because one of my coaching students thought this was actually a good deal. And so this is where having somebody on your side to help you analyze the deals and just bounce the numbers off is really, really important. Okay, so I'm going to bring up that deal, show you why it's not a good deal, and then we'll just analyze it from there. Okay, and then we're also going to analyze, answer some real estate questions as well. Okay, so in the meantime, while all that is happening, if you have comments or questions, please feel free to dump them in the chat box and I will be sort of checking them periodically. And then I also need to remember to put a disclaimer out there. All of the ideas and content comments that I make are really just my ideas and my, what I'm doing, and they may not be good for you. So before you go and implement or take any of the advice or ideas or anything that I throw out at you today, please go and check with another real estate investor or your lawyers, accountants, just bounce it off somebody before you implement it. Okay, so good. So I got that disclaimer in there. Okay, so let's go into this deal that I'm mentioning to you guys in Manitoba. And I do have to have a firm cutoff today at 1:15 because I need to attend a Zoom meeting with one of my business partners. So unfortunately, I am going to have to get off fairly quickly and right on time. So here is the listing. Okay, so you on the screen you should see. Okay, you should see the okay, so the 249 Kilbridge Avenue, I'm assuming that's what that's called. Okay, so I'm just going to put that onto my main screen there, so hopefully you can still see that. Yeah. Okay, so this one is in Winnipeg. Ask about rent to own, or VTB. This gem of a starter home or investment property features sleek vinyl plank flooring, stunning cabinetry, and loads of lights. Have a look at the living room. Okay, blah, blah, blah. Okay, so the excellent continues outside. Okay, and then that's it. Okay, so this is the picture of the house. It's asking $219. So the price point on this is amazing. Okay, so what I'm going to do now is just show you the Excel sheet on how this analysis was done. Okay, so let me go to the unshare on this one, and I will bring up the Excel sheet. So here's the thing. Finding opportunities or finding listings, that's one of the easy parts. The harder part is actually running the numbers and understanding how the numbers work. Okay, so before I share, let me bring the Excel sheet over onto this screen here. Okay, so I'm going to do that. And then now, of course, I've lost my Zoom here. Okay, so let me share with you the Excel sheet. Where is it? Okay, here we go. Okay, so this is the trusted spreadsheet that I've been using for years and years. And of course, you could use the Bigger Pockets, Deal Check, all of those online sheets. I always like to use my own spreadsheet because it's what I'm comfortable with. Okay, so put in the address, the asking price. Okay, at this point, we're just putting in a 50K renovation cost, like a reserve fund. Okay, so it's a 3-bedroom house. We're estimating $1,300 in rent. Now, keep in mind this, because this is a single family, it's only one family that can move in there. If this was a multi-family, like a triplex, then you would have three units, 3 sets of income, potential rental income. Okay, so because it's only one unit, it's $1,300. The annual rent is $15,600. Okay, so it's not too bad. Now, the problem here is that this doesn't meet the 1% rule. Okay, and the 1% rule is where your rental income is 1% of your purchase price. So in order for this to meet that 1% rule, it needs to be making about $2,000 in rental income. Okay, now it's pretty hard to find places that will let you meet that 1%, but that is one number, one metrics that people look at. Okay, so it doesn't meet that 1%, so that's fine. So now let's go here and look at the information on the expenses. So as you can see, there's no utilities being put in because we're assuming that the family moving in is going to pay 100% of the utilities. Now, this is a little bit misconceiving because let's just say when there's nobody there, or while you're trying to find a tenant to move in, you still have to, as the owner, cover that utility bill for a little bit. And if your tenants don't pay the utilities, you have to still pay it. Okay, so keep in mind that it's not the best policy to assume that your tenants are going to pay 100%. Okay, and then if you're doing the analysis on a multifamily, you want to you want to at least account for the utilities in the common area, like say for parking, for the hallways, for the laundry room. Okay, so the taxes are in here at $2,600, so that's fine. The insurance 15, property management is 10, and I always put 10%. Even if I can find a property management company for 7 or 8%, start the analysis at 10 because here's the thing, I'm not going to move to Manitoba. Okay, and so I'm going to need to find somebody local, and you don't know if you're going to be able to find somebody at 7 or 8%. Okay, and especially with a single family, you have to make it worth their time to help you manage that property. Okay, repairs 5%, vacancy 8%, and others is 5%. I always leave those percentages in there. Now, I know that people are like, but Hung, if you do that, it's never going to cash flow. It's never going to cash flow. Well, here's the thing. I'd rather have enough cushion to cover my expenses than not enough and then having to pay out of my own pocket every month. Okay, so the 5% other is to cover accounting, legals, any capex, okay, like the roof, the furnace. Okay, the 5% maintenance is the ongoing repairs that has to take place, like maybe landscaping. Okay, the dishwasher goes, the microwave goes. Okay, now you can build some of those costs back to the tenants. Okay, but at the same time, you don't know that for sure yet. Okay, and I always use an 8%, especially with a single family. You're going to be at a higher vacancy because if they go, you have no income at all in this building. If you're doing a multifamily, then your vacancy allowance could be 4%. It could be 5%. Okay, so you have to sort of run it based on the type of property you're buying. Okay, so the monthly expenses is $700, annually $8,005. Okay, so now we're going to say, let's just assume that we put 20% down. So we have a down payment of $44,000. So very manageable. A lot of people can take this from a line of credit or a bunch of credit cards combined. Okay, so this down payment is fairly easy to do. And when we originally ran this analysis, we said, okay, let's assume we're going to do a vendor take back because these people, the seller was advertising for a rent to own. So let's just say they cover that 80% for us. Okay, so I'm putting in a 6% loan here of interest rate. So that right there is $1,000 a month in interest. So let me just see. Yes, so that's principal and interest. And so that means now I'm negative cash flow, $460. Okay. And the reason why it's negative cash flowing is because it's one rental income. Okay. And so it makes it very hard for a single family to cash flow. So now, maybe the sellers are willing, okay, to do maybe 4%. So let's just say we go in at 4%. Okay. So now, okay, there we go. So now we're still negative cash flowing at 245. Okay. So now maybe you can negotiate with them and say, hey, Mr. Seller, can we do 0% and defer any interest payments until the end of the year? Can we defer payments until 3 years? Okay, and so that's where you're going to want to run the numbers and say, okay, well, wait a minute, this cash flow of 105, does it make sense at that point? Okay, so now let's just say we defer the payments. Okay, and at this point, then what we're doing is getting cash flow. So I'm actually going to type that out here because this is a concept that I want to make sure that is understood quite well. It's the concept of camping, which is when you are in real estate, you want to be camping. Okay, and camping stands for cash flow, appreciation, mortgage pay down, increasing net worth for generation. Okay, and you want to look at every single opportunity as a means of increasing your net worth for generations. And if it's not increasing your net worth for generations, it's probably not going to be a good opportunity. Okay, so this opportunity here, you want cash flow, appreciation, and mortgage pay down, those three things. So we already know we're going to have mortgage pay down because as long as you have principal being paid down, that's your mortgage pay down. Okay. Now the problem is that if this is an interest only, okay, interest only, which you can find in the market today, interest only payments. So let's just say even if it's 0%, and you defer the interest only payments. Okay, so let's just say this is 6%. We're going to go back to 6, and now instead of principal and interest, so the principal and interest would be 1,000, but now what we're saying is we're only going to be paying interest. Okay, so I'm going to go over here and we're going to just say interest only. Okay, and what I'm going to do is I'm just going to say it's 175,000 because that's the price that they would be lending you times the 6%. Okay, so you can see that it's 10,555. Okay, so that's this number right here. So I'm going to highlight that so you could see it. Okay, so that's this baby blue cell there. Okay, so your interest only payments per year is 10,000. Okay, so now we're going to say per month. So let me just see. Yeah, so that allows me to do that. So I'm going to take this number, divide that by 12. Okay, so that means that you're deferring $800 a month. Okay, so the reason why this is an important number to note is that you have to pay this at some point. Okay, so even though they're willing to defer it for a year, okay, you still have to pay $880 a month, okay, at some point. So if you are, okay, so hold on. So I'm just going to copy this down so we have that. And I'm just going to say paste. Oop. Okay, sorry, so I'm using a Google Sheet so that we can do that. So I'm just going to go over here and I'm just going to type in that number, 10555. Okay, and then 879.6. Okay, because what's going to happen is these numbers are going to change once I go back over here. Okay, so this now is, Okay, so now I'm going to go to 0% here. So even if they give you a 0% mortgage right now because they're deferring the payments, you're only going to be cash flowing $100 a month. Okay, so that means this $100 has to be saved or utilized in some way so that in the future you can still pay back this $880. Okay, so now that's the cash flow portion. Okay. Now, if you are doing interest only payments, there's no mortgage pay down. Okay, so just make sure that you understand that concept. There's no mortgage to pay down. So now let's go and look at, so let's just say this is, okay, so we're going to leave it at 0%. So I'm going to go to this other sheet here, because what I want to say now is, let's just say the loan is a 25-year amortization, and we're looking at a 2% appreciation on this property. Okay, it could be higher. Okay, so let's just do the analysis right now on 2% and see what happens. Okay, so assuming that all of these numbers are right here, we've got a down payment of 219. Yeah, because we're doing a VTB on that. Okay, property value there. Okay, so I'm going to go down here and change this to my down payment number, because I'm not using the whole amount. I'm actually just using this number here. Okay, so there's my down payment. It's zero mortgage right now, so I'm just going to assume that there's no mortgage. I only have $54,000 invested. This is for closing costs, legals, and stuff like that too. So there's the income, the expenses. So this is being pulled from the other sheet. Okay, so that's fine. So we're just going to, oh, there's a gas number here. So let's just see why that number is there. Okay, so this was a manually put in number, so I'm just going to get rid of that. Okay, and let's see, do these go? Yeah, so this should just automatically disappear. So we're just going to put 0 there. Okay, so now with the utilities, assuming that there's no utilities, the tenants will cover that. If we have a 2% appreciation and interest only payments, okay, so the property value goes up every single year. Okay, what's happening here is the return on your investment is about 8 to 9% year over year. Okay, so for me, that would be a no-go, because I'm looking for opportunities that are at 15% minimum. And then if I'm partnering with somebody, then we're splitting that 15% in some way. Okay, so if I'm going to be doing an opportunity and I'm only looking at 8%, I would rather take that cash that I have and maybe go pay down some credit cards, maybe go do a different strategy where I already, it's the funds are going to be a little bit safer than putting it into an opportunity that is not in my backyard that I would have to go and hire out. And this one, because it's a single family, you're increasing your what do you call it, your risk level there. So I'm going to update that and see how that changes the numbers there. Okay, so now if you're looking at this, you might be like, well, Huong, how come the return on investment is 300%? Okay, so now you have to understand how this is working, because you're only putting in the down payment of 43 plus the closing expenses. So it's assuming that you have a 0% mortgage, because your year-end equity has gone up to the full amount of the property. But this is misleading, because you still have to pay that $164,000 back. Okay, so it's not 300% ROI. Okay, so what it is, it's actually 8%. Okay, so now if you look at the mortgage balance here, it says 0. So there's technically very little cash flow, if no cash flow. You have no mortgage pay down, and maybe 2% appreciation. So now let's just say we run this at 5% appreciation. So then every single year it goes up by 5%. Okay, well then your return on investment is at 20%. Okay, but the thing is, though, I don't know that area enough to know whether or not it would give me 5% appreciation. Okay, and I don't want to count on that appreciation. Okay, so now keep in mind, real estate is a very long-term strategy, in the sense that you want to buy a property and potentially hold on to it for long term, until you can get that value out. Okay, so if it's at 5%, then your return on investment goes up quite a bit, and at that point I would say, okay, maybe it warrants another look. Okay, but without knowing if the appreciation's 5% or not, I would say, yeah, you know what, it's probably not worth doing. Okay, all right, I hope that answers this question on how to analyze a property. Okay, so I am now going to jump into answering some questions that came through. All right, so here we go. Okay, so let's look. Oh, okay, so this actually might need another spreadsheet. So we will bring that up. So this is a question that came through while we were on our monthly mastermind. And this question was, one of my colleagues is looking at a strategy where they are doing agreement for sales. And so far, all of the agreements for sale is negative cash flowing, meaning that, like what we just did there, once you have all the income minus all the expenses and all the debt servicing, it is still negative cash flowing, even if you're doing an agreement for sale. Okay, so you are potentially getting mortgage pay down, you're potentially getting the appreciation, and yet there's still negative cash flow. And so the question that came back was, is it still a good opportunity if you have negative cash flow? Okay, and here's the thing. If you're investing and it has negative cash flow, then you've got to figure out the numbers to figure out, okay, well, how can I make it positive cash flow, or at least break even, or at least have enough reserves in there to cover any of the capital expenditures that are needed while getting mortgage pay down, while getting appreciation. Okay, even if appreciation is 1%. Okay, so you want to analyze the numbers to the next step and say, okay, well, how can we make this opportunity work? Okay, now the other thing is that if it doesn't have some sort of cash in there and no mortgage pay down and potentially no appreciation, then why would you even do that deal? Like, there's no way that that deal would be sound at all. Like, you want to make sure that the mortgage pay down is enough to cover the negative expenses and potentially make it worthwhile make it worthwhile your time. Okay, so let me bring up that spreadsheet again, and let's see if we can figure out a way to make that opportunity work from an agreement for sale point of view, if that was the opportunity coming through. Okay, so this was the one that we were looking at in Manitoba, and let's just say that the seller is allowing us to do an agreement for sale. Okay, and they're going to cover this. So it's not a vendor take back at all. That's completely different. So just imagine if that was written as an agreement for sale here. Okay, and so in the future, we're going to have to settle this amount. Okay, but what happens is, with the agreement for sale, we're deferring the closing until 2 years time or 3 years time, and so we would have that mortgage pay down. Okay, so let's just say we're doing the agreement for sale and we're going to take over their mortgage payments, and let's just say they're in a mortgage of 4% here. Okay, so they have an existing mortgage at 4%, and we're going to take over the payments. Okay, and so what's going to happen is every single month we're going to pay $839 to whoever the lender is. Okay, and so we're going to be out of pocket $245. So it's not in addition. Okay, it's just $840 will go to the lender. Okay, so now what happens is, every single month we're going to, okay, so let me go in here and we're going to just change this because we want it to actually have, okay, hold on, I'm going to go back over here and I'm going to actually put in 175,920 here. Okay, and I'm going to put 4% up here, and I'm going to put 0 here. Okay, so that's all still the same. So now we're over here, and let's see if this mortgage balance gets updated properly. No entry, I-27. Cash flow is 7,000. Okay, so there should be a mortgage. Oh, here we go. The first mortgage is this number over here. Okay, so now as you can see, the mortgage comes down every single month. Okay, and let's just say we're going to go back to the 2% here. Okay, so now what's going to happen is that every single, there is a cash flow here of $7,900 a month, sorry, a year. Okay, so this is per year. So now you have to find out, okay, well, what's happening is that there's 200 minus 245. Okay, so I would actually figure out why there's a positive cash flow here, when especially it's saying that it's minus cash flowing on the other sheet. Okay, the cash that I've invested is 54, property value is 219, the year-end equity is this. So let's go in here, data note entry F45. So we're going to go in here. Okay, I see. So what's okay, so here's the rate here. That's why it's assuming a 0% mortgage rate here. So let's go down here. Right. Okay, so that's the, did we say it was 6% or 4%? Let me see here. Okay, yeah, so 4%. So let's go back here and look at that 4%. Okay. So the 4% is there. So there's the negative cash flowing number now. The amount we invested, the property value is going up every single year by 2%. So then my year-end equity is this amount, because now there's mortgage pay down, even if there's no cash flow. Okay. And so what you're getting is that mortgage pay down and the 2% appreciation. So you're getting those two. Okay. So now your return on investment is around 20% year over year. So that's actually okay. Okay. So now let's just look at this and say, okay, hey, you know what? If we could get $2,000 in rent, okay, now we are positive cash flowing, okay, by about $4,000 a year. So that would make us cash flow. And then this amount here, okay, should be going up, right? So your cumulative has gone up, and then your ROI has gone up a little bit. Okay, so there's your cash flow there. So now let me just check something. So I'm going to go back 3,000. Yeah, so then the return on investment has not gone up. So where is it taking the numbers from? So it's this minus this, okay? And then this number here is, say, my total cash invested divided by my year-end equity. Okay, so yeah, so because you're negative cash flowing, there's no gain there. Okay, but now if you are going to be positive cash flowing, so let's say we go back to the 2,000 here. Okay, that's positive cash flowing now. So now your cash invested is this, your property value has gone up, your year-end equity is this number here. Okay, so it should be, it's taking down your mortgage payment, your balance, plus your cash invested, plus the appreciation amount. Okay, so this is actually not considering your cash flow. So your year-end equity, if you wanted to, you would actually add in your cash flow. There we go. Okay, and I'm just going to put that all the way down. Okay, and this one as well. Oop, here we go. Okay, so now you can see that the return on investment has gone up by a little bit of a percentage there. So let's go back over here and we will change this back to 1,300. Oop, 1,300. Okay, so there we go. So you can see that negative cash flow, or if you want to say that positive cash flow, okay, accounts for about 1% of your return on investment. Okay, so that's where you need to figure out, okay, well, do I want